Let's talk about Japanese intervention. It has finally happened. Dollar yen soared above 160, and that became the line in the sand in the Japanese yen. We saw that the Japanese came in overnight to sell dollar yen. They didn't confirm it, and we'll talk about that in a second, but they did show us through the price action that they've come in to sell dollar yen at 160 is basically their uncle point. Hello everyone, this is Kathy Lean with BK Traders. We're going to talk about the Japanese intervention, we're going to look at the charts, we're going to talk about what this means going forward and whether they can come in again and whether we've seen a top in the yen pairs. So let's go to our charts. So this is my chart of dollar yen, and you can see that this is basically what we typically see with Japanese intervention, where this daily candle 160.23 high, 154.52 low, basically is almost a 650 point drop in dollar yen. And these are the candles that tell us that the Japanese have come in to intervene in the yen. Now, if we drill down to the 5-minute chart, we see this in further detail. First off, right around the Asia Open, dollar yen rallied and bursted above 160. But this is not necessarily an intervention because it bursted above 160, sold off, and then consolidated. This type of move is more likely to be, orders being triggered, stop orders being triggered at 160, or fresh sell orders being triggered at 160, and dealers, kind of maybe stopping their customers out, whatever it is. It's pulled back and then consolidated. Now, this pullback from its breakout point, its high is 160.23, and this mid-range is about 159.30. So it's less than 100 pips, and this is not intervention. This, on the other hand, is intervention. The Japanese government came in, they sold dollar yen, 159.57 was high. This low was basically 155. So 457 or so pips. And from high to low, 159.57 down to 155 was the type of move that you typically see when the Japanese comes in, where we have 457 pips of losses. This is intervention. And this happened over a 1 hour period. Then they decided to come in again. They came in over here right around the London Open. They sold dollar yen around 157.18, drove it down to 154.50. And this over here is a 250 pip move about in dollar yen. And so, this is the type of move that we do typically see when we have intervention in the Japanese yen, which is multi-100 pip moves in a matter of minutes. Now, some of this move took longer, and this became a 1 hour bout of selling, and this was about 30 minutes. But overall, this is a relatively short period of selling, and this is what intervention looks and smells like. Now, I'm getting some questions about whether or not they came in on Friday as well. And so on Friday, we had this huge move here. And so this move was basically 156.70 down to 155. It could have been intervention, but it's kind of unclear. And also, it's about slightly less than 200 pips. So this could have also been intervention by the Japanese government, intervening, before their holiday on Sunday night, and then also intervening on this holiday. So what does this mean? First and foremost, this is the first time they've come in since November of 2022. Going back to November 2022, their intervention was right over here, and possibly pretty much right over here. But what's more interesting to me is this candle, because today's candle, the April 2024 intervention, looks like this candle, where we had a really steady, strong rally in dollar yen, strong intervention, and this is what today's candle looks like. So, what we can see is next day we retrace, and then we start to move lower again. Here on this day, when we had the next intervention, we did not retrace. It dropped further, but it did retrace in the days to follow before it moved lower again. If you look closely here, even though it did revisit its lows, the real move lower in dollar yen didn't really happen again until they came in November. They didn't necessarily break the previous lows, and it really wasn't until in November. So what this suggests to me is that to today's price action, first and foremost, we took out Friday's low as well as some of the lows previously, but it did not close at that level. So what this suggests to me is that when we reopen on Asia trade, we could get a little bit of a push lower, and then a little bit of a rally, and then probably consolidation into FOMC. And then, maybe some additional consolidation. If we hear from the Japanese that they did intervene, or we see in the Ministry of Finance's monthly report that they intervened, that's when we could have the next leg lower. So basically, there's two ways for the Japanese to confirm that they've come in. They can either say it and said that they intervened in the market to try to, spook traders and to keep dollar yen from, basically recovering all of its losses and then, basically erasing all of their efforts, or they say nothing and they wait and release their monthly intervention report. And I'm going to include the link in the description of this video of where they post it. They basically post their monthly intervention report, and then in that they confirm that they intervened. If they do that, that's kind of really bad news, because that means that they don't really want to admit it. They're taking a more backseat approach. But when they produce it and we do see that they intervened, then that could trigger a new leg lower in dollar yen. Now, however, I've often said that in order for intervention to be durable, one of two things need to happen. Either one, it needs to be coordinated, and we know it's not coordinated because we haven't heard the Japanese say that it's coordinated intervention. We haven't seen movements in some of the other major currencies. We haven't seen other major central banks confirm they've come in with the Japanese government. Secondly, the other thing that could happen is if U.S. yields fall. The reason why this intervention effort in October of 2022 worked was because it coincided with a movement lower in yields. So if I put in the yield chart here, and I'm going to move this to the other side. Hold on, give me 1 second to move this, and I want to show it to you. Pin scale to left. You can see this was the intervention, and we're just going to normalize this regular. The reason why, the main reason why the October 2022 intervention worked is because it coincided with a peak in U.S. yields over there as well as over here. So in order for this intervention to work, it also needs to coincide with a peak in U.S. yields. Now, U.S. yields did have a little peak here, but whether or not U.S. yields truly peaks will hinge upon the FOMC statement as well as the non-farm payrolls report that we have this week. If the FOMC expresses new cautiousness, so basically suggests that maybe June or July they could lower interest rates instead of September, which is where the odds are more favoring right now, according to the CME FedWatch tool. You can see the CME FedWatch tool shows July interest rate cut, the market pricing in only a 30% chance of a July interest rate cut, and they are pricing in a 60% chance of a September cut. So if we have the Federal Reserve saying, the market is, way too ambitious in, or not ambitious enough in pricing in a summer interest rate cut, July is still on the table, that could trigger a more significant pullback in yields. Or if non-farm payroll comes in really weak, like 150,000, for example, that could also trigger a more significant pullback in yields. And so we need to see U.S. yields peak in order to have a durable top in dollar yen. Now, factors could be at play. We could be getting close. And this is the first time the Japanese have intervened since November of 2022. And so I do think this is significant, but it's really going to hinge on what U.S. yields do. And that's what the Japanese know. They know that it really hinges on what the U.S. yields do, which is why they've been so reluctant to intervene in the currency, because they know that they're fighting against the forces of U.S. dollar strength and U.S. dollar yields. But if we do get a scenario where the Fed, says July, not June, the market's expectations are, far, too pushed off to September, then that can mark a top in yields. Or if the jobs report starts to come out very, very weak. So those are things that we're going to be looking for a durable sell-off in dollar yen. Now, in terms of levels to watch in dollar yen, if we go back to our charts, I'm going to remove this 10-year yield chart after you've seen the 10-year yield chart. What I will say is that if we bring back our 1-hour chart, the levels to basically watch on the big, on a larger perspective is 157.25. If it gets back above, if dollar yen gets back above 157.25, we could see a more significant move higher. On the downside, we've got a lot of room to the downside, but I would say it'd be pretty much right around here, 156.25, which is the low from this candle here, and also some of these lows here. If we get below there, we could see a more significant move down to 155.50, and that's the first level of support, and then possibly down to 154.50. So those are the levels to watch for dollar yen if you're trying to trade the breakout of the ranges. But regardless, Japanese, everything smells and looks like intervention. I'm pretty confident the Japanese have come in for the first time since 2022. And so 160 is officially the line in the sand for the Japanese government. We know that now, and that's the level that everyone is going to be fading the move against. This is Kathy Lee with BK Traders. If you want to learn more about how to trade with fundamentals, make sure you subscribe to my channel, hit the notifications button for updates, and check out our fundamentals course in the description below.